Welcome back to the virtual Midwest Staffing Conference. Our 3:30 session is Staffing Always Comes Back Stronger, presented by Nick Andriacci of Madison Resources. Welcome, Nick.
I thank you, Laura, and thanks everybody for attending and listening today. Appreciate the time you're taking out of your day for the presentation. So I really do hope this will be of value to you. A little bit about myself. I have been in the staffing industry on the funding side since 1992. I currently work for a company called Madison Resources, and we provide funding, back office services, and other support features, technology collections to independent staffing companies across the country. We help startups get going and larger companies grow further in their pay further, whether through organic growth or acquisitions. So that's a little bit about what my company does. I chose this topic because I've seen recessions now since the early 90s. Okay, and after each and every time, the staffing industry comes back much stronger than they went in. And I think generally the staffing industry is more nimble, and we tend to adapt to market conditions as they change. So this presentation is going to focus on three items. Number one, what causes recessions and how can we see them coming? What are the signs? Number two, how to navigate through them and prepare for recovery. Every slowdown is a little different, and every recovery is a little different, but there's going to be a main theme in this as we go through the presentation. And number three, and this happens all the time, what industries emerge, what companies start, and what looks to be growth areas when we come out of a recession. Now, I do know technically we're not in a recession right now because it's two quarters of negative growth. But let's face it, we all know that the economy really did stop with the stay-at-home orders. Okay, so the first thing is how to see them coming. Now, this isn't an economics lesson per se, but we operate in a very transactional economy. Okay, so we have a flow of products and a flow of goods and a flow of money. Okay, so as money tends to flow from the economy, so businesses, they pay their vendors, individuals get paid, and they spend money on products. And same thing with businesses. As you can see, the circular flow, and it happens over and over again. So that in essence is how the economy is supposed to work. Okay, and when it's working fine, we all know there's growth, and as staffers, we see our payrolls grow and business grow, and everything's wonderful. But as we know, there's always disruptions in what happens, okay, in economic activity. And there's a new number of reasons for those. And if we go back and take a look at some of these past recessions, so in 1991, we had a geopolitical disruption, which was the Iraq War. Okay, caused a spike in oil prices and very pessimistic consumers, worried consumers that the war may spread outside of the Middle East. Okay. Secondly, the next recession is 2001, and that had a lot to do with overinflated evaluations, the dot-com boom and bust. Some of you may remember Alan Greenspan and his statement of irrational exuberance. Okay, so once the tech market came down, businesses slowed down spending. Part of it was Y2K, of course. They made a lot of investments in technology. That all slowed down, caused us to go into a recession. And of course, 9/11 didn't help. Okay, 2009 was the financial crisis. And that had to do with the subprime mortgage lending. A lot of bundled mortgages that were being sold as bundles without the buyers not really knowing what was in them. It became a problem when they opened them up and realized there's a bunch of junk mortgages in there. And it just obviously caused a very bad domino effect. And then, of course, right now there's a worldwide pandemic, which is COVID-19. And the stay-at-home orders have caused disruption in economic activity and the circulation of money. Okay? In all cases, money circulation slows. Okay, so what they term as the velocity of money, and that is really just roughly defined as how fast money changes hands in an economy. Okay? The formula is gross domestic product divided by the money supply. Again, this isn't an economics lesson, but it's good to know what economists look at and what they look for. So basically, the velocity of money, or how many times it changes hands during the year, is typically higher in expanding economies and lower in contracting ones. And so what that really means is consumers and businesses spend less, which cause contraction. As you can see here, a handy little chart here from the Fed. This is the velocity of money. So in years where the economy expands, it grows. And then you see here, this is 1960, it falls. These shaded areas represent recession years. And each and every time you see a fall off in the velocity or circulation of money. So that's that indicates a good sign of what's to come, or what is happening now. Okay, you can see here I went as far as I could, big tail off right at the end. So again, money slowing down, and we expect it to as people stayed home. Okay? Hope that makes sense. Then that usually spurs actions to be taken. It usually spurs actions to take to help end the recessions. Okay, you have monetary and fiscal policy, and we always hear it as stimulus. Monetary policy is what the Fed does. Basically, they make sure there's liquidity in the markets. They make sure there's plenty of money out there to lend. They can lower interest rates to encourage consumers and businesses to borrow and invest. So that's what the Fed does. In terms of fiscal policy, that's what the government does. So that's where you hear tax cuts, the extra $600 in unemployment benefits. That one right now is considered a stimulus. PPP loans, which some of you probably have, or some of these middle market loans that they're able to make. So that's from a fiscal policy. My personal feeling, and as someone with an economics degree, monetary policy has more of an effect. Market adjustments. Okay, so the market makes adjustments. For example, you see lower gas prices out there. That essentially puts more money in consumers' pockets and businesses' pockets, so they can use it for something else. I threw in airline fares because you see a lot of fares on sale, and that's to try to encourage consumers to get back on airplanes. But as they do, that also stimulates the economy. Okay, so that's important. And then of course other stimulants that encourage business and consumer spending. Overall, business and consumer confidence. My feeling again is pent-up demand may drive expenditures even more than confidence. Sometimes you may not be a ton of confidence out there, but you really want to do something. You really want to get outside. You really want to go eat at a restaurant again. Talking about now, and that may drive expenditures, people to spend money. And of course, last but not least, entrepreneurs, innovators, and staffers. This is really the key component that gets us out of recessions. Okay, the innovators, the entrepreneurs, the ones that start businesses, the ones that start industries, and of course, staffers, you guys. I'm going to get into my rah-rah slide here in a second, but staffers are so important to get the economy going again. I consider it the right stimulus for the economy. The staffing industry, as you guys know or should know, you're the ones that help employers start hiring again. Okay, you guys are out encouraging people to add staff, not lay people off. staffers that place contract employees. That's huge. The temp business. You offer your clients the ability to control costs and provide an efficiency and flexibility while they add employees. That's just a wonderful, wonderful tool. Staffers also help candidates. This is really almost a community service of what recruiters and you guys do. You help otherwise good candidates, but maybe not know how to market themselves. You help them develop a career path or prepare for an interview or edit or write resumes. I mean, you guys all do that, and it helps them get employment. And the win-win-win for everybody, for staffers, for the candidates, and for the clients. 72% of these temp workers, they find full-time jobs in less than a year when they're working with a staffing company. So that's really a key for candidates to know that, hey, this isn't a temp job. Almost 3/4 of the time it turns into a real full-time job with benefits and upward mobility. That's a win for everybody. And then, of course, you guys are part of the small business job creators. Almost 3 out of 4 jobs, and in particular coming out of recessions, are created by small businesses. And the big part of the staffing industry are mom and pops or regional players that are not Manpower, not Kelly. This is nothing against Manpower or Kelly, of course, but it's the mom and pops that really grow. They're the innovators. They could change on a dime, and you guys do that. As you guys grow, you hire more recruiters and salespeople, and that's just a wonderful thing as far as growing the economy. Okay, so we talked about that a little bit, about looking at recessions, how we identify them, and stimulus and things that can help get us out of recessions and the economy moving again. So what about now? What can you do now? Okay, I mean, Illinois, unfortunately, is not quite open. Those that are joining us from Wisconsin or Indiana, you guys have a little more activity going on. What can you do now? The first thing I would say is stay connected with your customers. They'd love to hear from you, even though they may not have open orders or may not have demand quite yet. But I think when you show sincere compassion, you guys have a customer base out there, and not every contact, needs to result in a financial transaction. Ask them how they're doing, how they're coping during this time. Hopefully it won't be too much longer, but it's always good to reach out and connect, and have a sincere interest in their business and themselves. Okay. Competitors closing. Now, I hope nobody on this call, or you never want to see anybody go out of business. But unfortunately, when times get slow, there are some casualties, economically, with the slow economy. But look around. Some of the bigger players like Robert Half or Manpower, they have stockholders they answer to. So if they have branches that may not be performing like they'd like, they'll close them. They'll close them. But typically they still are doing business, and that business has to go somewhere. So keep an eye on it. I mean, you see somebody close, you have an idea who they're doing business with, maybe a good time to contact them. Okay. Or maybe there's an opportunity for acquisition. If you hear of somebody that's closing, maybe you can acquire the business and have it pay off over time. It's another consideration of what to do now. And of course, whatever you do now, position your company to grow when the economy opens up. It will be sooner than later, I'm sure of it. Okay, so hopefully in the next 2 months or so, 3 months or so, we'll be back, almost to at least restrictions wise, have fewer restrictions so the businesses can grow again. Okay, but you need to be in a position to take advantage of that when that happens. Okay. Staying with the here and now, industries that have current demand, obviously COVID responders, whether it be temperature checkers or contact tracers, or test administrators, or for other frontline workers. They are looking for those responders, and there is some opportunity there. Okay. Obviously, certain warehouse or transportation for product delivery, the items still need to be delivered to stores, manufacturers, some of them at least still need to be open. Okay, warehouses still need to be, storing goods and moving them out. Truckers need to be delivering them. So look at those areas for growth, or not necessarily for growth, but certainly for demand. IT support roles. We see this here at Madison as pretty strong. Our IT clients, it's slowed a little, but not very much, because most of those jobs can be done remotely. And also now there's this other little phenomenon going on with, companies needing to support remote workers, remote employees that they may not have had. Maybe they didn't have things set up or set up enough to where they've had to go now. So there's IT support roles in those areas as well. And then, of course, lastly, anything deemed an essential service. Grocers or Home Depot or what have you. LinkedIn every day has like a top 10 job posting. So when you're on LinkedIn, take a look for that, and they show the companies who are hiring. Certainly, there's probably areas there where a staffer can help or find some open job orders. Okay? Hopefully that helps, or at least give some ideas. All right. As a part of what to do now in getting your company ready to grow once the economy opens up, contract staffing grows quicker after recessions. Okay, it always seems to do that. If you look here, this is the early 90s. This line here is the growth for temporary help. Okay, and this line here are just general non-farm payrolls. Okay, tend to grow after recessions quicker. Recessions hit, yes, contract staffing gets hit first. You can see this in these two highlighted areas that represent recession periods. Okay, so they get hit quicker, but then tend to rebound afterwards faster. So again, in preparation for growth, I've always seen contract staffing since 1992 lead the way out. It's a leading indicator. Okay, permanent total employment or perm employment tend to be lagging. Well, employment in general is a lagging indicator. So let me back up for all the economists that are out there. But certainly of employment, contract leads the way, okay? Permanent tends to follow. Generally, there's more demand in contract staffing until there's enough confidence to start hiring full time. And a lot of that is temp to perm, okay? So you do see a lot of that. It also, in the future, provides a steady, stable stream of income. Perm tends to be more transactional, and certainly do perm. I mean, that's direct hire. That's a good business. I'm not knocking it, but contract staffing tends to be more stable. So for those that have, I'm sure most of you have a contract offering. If you want to make it a little more robust, now's the time to do so and get it ready, because I think that's where the opportunities will be. And in the end, your staffing company will be worth much, much more if there's more of a focus on contract. But that's way down the line. But again, you always have to position yourself for later. All right. Now, for those that are looking to ramp up or maybe even start a contract division, it's very easy, and you could use other people's money to do so. Okay, I know there's costs involved, obviously, more cost with contract staffing than there is with perm. Okay, and you have two types of costs. You have fixed costs that are not output dependent, and that just basically means you could potentially have some large upfront costs and reoccurring costs. Okay, and it doesn't matter whether you do $1 million a year in business or 50 million. Okay, you're going to have these fixed costs. Or you can ramp up using a variable cost model, okay, where the variable costs are output dependent. They're very proportional with revenue. A lot of times you could grow the contract business with very little upfront costs, and those costs will rise and fall with revenue. That's a very nice way to do it. Okay, very little risk on a staffer end. Time and money, obviously, those are the two components you need to grow. And you need capital to grow and fund your payroll, and infrastructure to process payroll and invoicing and collections. Okay, and there's lots of companies, or shouldn't say lots, but there are some companies out there that do it. Obviously, Madison does, but I'm not here to plug Madison. Just to let you know, there are ways to do this, okay, without a big upfront cost or going back to your bank and asking for a line that they're probably not going to give you, or not enough of. Okay. But regardless, by outsourcing these things, the leaders can focus on all the fun stuff: sales, recruiting, and customer relations. And those are the three things that are going to grow your business coming out of. So as long as you are ready and you're structuring your business now for the growth that's going to come later, you'll be in great shape. Trust me. Okay. So anyways, last but not least, we're going to get to the let's go part. So I hope this generates at least a few more ideas for you guys. Okay. You know, like the stock market, the time to act is when most are quitting or when most are selling. Okay. And that was a little story actually both my uncles told me, and both these guys, neither one of them have a high school degree. But they're very good. They always told me, you know, that the time to buy or to get into business is when people are getting out. So, you know, basically, you know, what is it? You see it's darkest before the storm or the end of the storm. But again, you know, it's like right when you're ready to throw in the towel, that's the time to get in. I think the stock market, using that as an example, got down to almost 18,000. The Dow did. And I think today it's getting close back to 25,000. Who would ever saw that? Hopefully it stays that way. Okay. But a good time to get into business is when people are quitting. Okay. Again, recessions, they're over before you know it. That's the good thing about them, is that, you know, a lot of times, you know, you don't see that in the media or in the national number, but people who are in business, they see it quicker. Okay. And they do tend to end before we see it in the numbers. We're seeing it a little bit here at Madison. The last few weeks, we haven't seen any more tail off in business from the temp business, at least. And back in my Damien days, particularly the Great Recession, we actually saw our clients bottom out maybe mid 2009. Towards the end, we started seeing them grow. And quite frankly, 2010 wasn't that bad of a year for the independent staffing companies. Okay, so I hope that sometimes it's hard to tell when, you know, you feel like you're alone. But I hope you don't feel that way if I could help benchmark some things for you guys, you know. But we aren't seeing any more fall off, and we are starting to see little bits of growth, and I think we'll see more. The other thing to remember is don't take too much stock. I don't want to say too much stock, but I think the next employment report may not look good because the employment numbers are taken at the middle of the month, which would be May 15th, and a lot of states are just starting to open up now or just opened up. So you'll see the reflection not next month, but the month afterwards. Okay, so if the numbers don't look good next month, don't freak out. Okay. And again, contract staffing comes back first, and your customers, they benefit from the variable cost model too. Okay, so by you guys giving them flexibility and a controlled cost, that helps them. They like that model. Okay, so they can grow with confidence. All right, industries. This is an interesting little slide here. Industries and companies that benefited after the last recession. You know, it's interesting. You know, what didn't exist or barely exist before 2010. Look at all these e-learning, and I know that firsthand because my kids have been e-learning now for the last 45 days. That really didn't exist before 2010, but it started then. You know, content curation, internet entertainment, you know, thank God for Netflix, digital marketing, virtual reality. data analytics, AI, online marketplaces. I mean, it's just this all came out of the last recession. All these industries were born and created then. Okay. And look at some of these companies that started in 2009, Instagram, WhatsApp, Venmo, Uber, Slack. Most of these are probably doing really well now because we're using them. So anyways, but the bottom line is new innovators, new industries will be created from this as well. Okay, so where will the growth be? I'm a big hockey fan, and I always love the Wayne Gretzky quote that he skates to where the puck is going to be, not where it's been. And so that's where hopefully as you position your company for when the stay-at-home orders are lifted, okay, where's that puck going to go? Where are you going to be to receive the pass and score the goal? We all know consumer behavioral changes will drive certain industries. It won't be the same after the stay-at-home orders lifted as it was before they started. So what was around in February is probably not going to be true in July. Okay, but there will be economic activity going on. There will be demand for products and services. Just anticipate where they'll be. Now, again, my hunch, because this happened so abruptly, I don't think we've ever seen 20 million people file for unemployment in a month. But since this was due to stay-at-home orders, we all know some of these folks in almost every industry are going to come back. Okay, maybe not all, maybe not 100% of them, but some of them will. And the contract staff will come back, and the contract staff will lead the way, like we've said. I think they might be more comfortable bringing them on as contractors and temps. But you got to figure most of the industries are going to add employees. Okay, if I had to guess, I would probably say medical would probably start first, and unfortunately, the entertainment industry, concerts, sporting events, conventions, that would probably be last, if I had to guess. Super local, those of you with branch offices or thinking about adding other offices, think about the localities that have less restrictions, because their economy would have had a head start. They'll have an edge. So if you were thinking about it in the past, now may be a good time to do it. Okay. Tesla is a good example. They threatened California about moving. I think they're the last car manufacturer there, and I think California did make a concession to allow them to open. But anyways, that certainly is going on. Another opportunity is obviously companies may have downsized their HR department. A lot of times that's considered overhead cost. This could be an opening for staffers to fill a need. They may not have the HR people to interview, and so they may rely on you guys a little bit more, and that certainly would be a help. And then of course, just like we talked about, which jobs will come back first, and where is their pent-up demand, and start thinking and really think about that, and that'll help guide you on how to structure your sales and marketing efforts. Okay. I think I made it in time, but in conclusion, I hope you find this valuable. In conclusion, I'm hoping this event gives you the ability to spot slowdowns quicker, the events that causes recessions, and allow you to react quicker. I hope you're better positioned to cope with them, or give some ideas on how to cope with them, like swapping fixed for variable costs. That's a good way to do it. Anticipate sectors of the economy that will come back first, and emerging industries. What did we learn from the past? What can we take to at least have some idea what the future might look like? And then lastly, I'm going to stress it because I think you'll be happier with it. I know so many of my customers over 30 years have told me this. They are really happy when they grew the contract side of the business to have a steady, stable cash flow and income. Well, that brings me to the end. And in order to be thoughtful, if you guys have any questions, please, you might be presenting them to Laura now. But if not, Here's my cell phone, my email address. I'm always happy to have a dialogue with folks that had questions about this or want to pick my brain a little bit more, or what I'm seeing in the industry. I'll be happy to share whatever I can with you guys. So again, thank you so much for spending your time with me. I hope and pray that this ends quickly. I wish everybody the best that may have family members or friends that are, fighting the COVID disease or have experienced economic hardship. My heart goes out to you guys, and hope that this ends soon and we never see this again in our lifetime. So thank you very much, everybody.
Thank you so much, Nick, for your insights and also for those very kind words. And I'd like to invite everybody to come back at 4:30 for our final presentation today, which is Philanthropic Staffing Strategy to Attract and Retain Talent. And that will be presented by Brinks Money. Thank you again, Nick and Madison Resources.
And thank you, everybody.